So here's an illustration of sales tax payable. So if we had cash register sales, our total register slip showed us that we had $10,000 in total sales in a period, then we would have collected $600 in sales tax, assuming that we had a rate of 6% sales tax. So we're taking that 6%, converted into a decimal, which is 0.06, times our $10,000 to determine our total sales tax liability. So the amount of cash that we took out of the drawer was $10,600 that we're going to be depositing into our account. Of that, only $10,000 of that dollars was sales revenue, in the sense that that was the merchandise that we sold. But at the same time, we also had this liability of $600 in sales tax that will show in a sales tax payable account. Again, a liability account that's short term. Notice it's not included as part of our revenue because it's not income to our business. We essentially, when we're collecting sales tax, are the middlemen, so we recognize the total sales, we attach this certain percentage towards the amount of goods that we were selling, and collect from our customers the end sales tax that we will then pay to the agency that we need to. So there are some times when your cash register may or may not ring up the total amount of sales and the total amount that you had collected in sales tax. You might have your individual price tags reflecting the total sales price, and that's what you're ringing up or you're recording. So it's easy sometimes to back out the sales tax because, again, you don't want to include the amount that you're depositing, that $10,600, as your total sales revenue. You want to make sure that you're only counting $10,000 as your revenue, and then the other 6% is a liability. So if you didn't know, based on the sales receipts, how much of that was attributed to the sales tax, if you just take your sales tax rate and back it out of the total sales, so if we take the total sales, $10,600, and divide it by 106%, we would then determine that we would have $10,000 in sales, which this 1.06% backs out the sales tax for us. So then we can record that $600 into our sales tax payable account for reference, and again payable to the agency that we need to. We've talked off and on about the unearned revenue. Recalling that unearned revenue is when your customers pay you in advance for a service or products, and you anticipate delivering that to the customer at some point in time. But when they pay you in advance, you don't record the revenue until you've actually earned the revenue. So we need to hold that revenue in a liability account. And then once that revenue's been earned, we will go ahead and adjust the unearned revenue to include how much we've actually earned in a time period. So for example, if we had, again, $10,000 for some season football tickets at $50 each, we could show the sales for the $50 times the $10,000 for total sales of $500,000. Now, because this is for future games, we're not going to record this $500,000 as sales revenue at this time. We are going to show our asset cash going up, but we're also going to show the liability account unearned revenue for the amount of tickets that we sold in advance to the games being played. Now, when each game is played, then we will go ahead and journalize and do adjusting entry to record how much of that unearned revenue has now been earned. So we'll take it out of the liability account, unearned revenue, $100,000, into our ticket revenue to reflect how much was earned in that period. The majority of this chapter is going to talk about the bonds, looking at long-term liabilities, so kind of moving away from the short-term liabilities. Long-term liabilities, bonds, are another way for business owners to essentially raise capital in their business to allow them to get additional funds to operate and work within their business. A lot of times bonds are sold